8 months ago, Bitcoin touched $120,000. Today, it's sitting around 66,000. That's a 45% drop from the peak. And if you bought any time in the last year, there's a real chance you're underwater right now. So what actually happened? Because this wasn't one bad headline. This was four different forces hitting at the same time. First, the Federal Reserve. In June, the Fed removed language about progress toward its 2% inflation target. Two voting members openly said rate cuts expected for Q3 might get pushed into 2027. The 10-year Treasury yield jumped 18 basis points in 3 days, hitting 4.82%. For big institutional money, that math is simple. When risk-free returns go up, holding an asset that pays you nothing to hold it becomes less attractive. Second, Strategy, the company formerly known as MicroStrategy, sold Bitcoin for the first time in almost 4 years. Only 32 coins, financially meaningless, about $2.5 million against a $60 billion treasury. But symbolically, it broke a 4-year pattern of pure accumulation. And in a market this nervous, symbolism moves prices. Third, the ETFs. This is the big one. U.S. spot Bitcoin ETFs saw a 13-day outflow streak, the longest since they launched in 2024. $4.3 billion left those funds. Total assets under management fell from over $104 billion to $80 billion. BlackRock's IBIT, the largest fund, is still up cumulatively for the year, but the broader category just erased months of progress in less than 2 weeks. And fourth, geopolitics. Rising tension tied to the Iran situation pushed up oil and inflation fears simultaneously, which fed straight back into that Fed rate cut delay story. Risk-off sentiment hit gold, hit stocks, and hit Bitcoin all at once. Here's the thing analysts keep repeating. This wasn't panic selling. A lot of these institutional positions were opened back in Q1, around $52,000 to $58,000. When Bitcoin rallied 34% and touched 74,500 in late May, those holders were sitting on serious, unrealized gains. The rate scare just gave them a reason to lock in profits. Now, where does this leave the price? Technically, Bitcoin is deeply oversold. The 14-day RSI sits around 35. The Fear and Greed Index reads 18. That's extreme fear territory, the kind that historically marks local bottoms. But oversold doesn't mean about to bounce. It can stay oversold longer than most traders can stay solvent. On the bear side, prediction markets currently price an 80% chance Bitcoin falls below $60,000 again before the year ends, and a 52% chance it breaks $50,000. Just a month ago, traders gave it nearly 50% odds of hitting 6 figures again in 2026. That number has dropped to 27%. On the bull side, the structural argument hasn't changed. Stock-to-flow and power law models, the long-term frameworks some analysts use to value Bitcoin against its fixed supply, still point to a range of $100,000 to $150,000 if institutional adoption resumes. And there's already a tell that it might be resuming. On June 12th, every single one of the 12 tracked Bitcoin ETFs posted inflows on the same day for the first time in weeks. $86 million came in. Small, but it broke the bleeding. So which story is right? Probably neither one cleanly. The honest answer is that Bitcoin right now is caught between a macro environment that's actively hostile, high rates, geopolitical risk, profit-taking after a real rally, and a long-term adoption story that institutions haven't actually abandoned. BlackRock's fund alone still holds $62 billion in cumulative inflows since launch. That money didn't leave. It's just not growing right now. If you're holding Bitcoin through this, you're betting that institutional demand returns once the Fed signals clarity on rate cuts. If you're standing on the sidelines, you're betting the macro pressure has further to run, and that $50,000 to $60,000 is still ahead of you, not behind you. Both bets have evidence behind them right now.
If you enjoyed this video, hit like, subscribe, and ring the bell. See you in the next one.